US Federal Reserve Chairman Jerome Powell's widely anticipated speech at the Jackson Hole Banking Summit on Saturday, Australia time, has sent share markets into a tailspin. For more analysis, I'm joined by independent economist Warren Hogan on set with me. Warren, thanks for your time today. Just talk us through the significance of this speech for Powell, where he basically says inflation's still too high and interest rates are obviously going to need to keep going up.
Yeah, well, he's been hawkish for a month and the market was expecting to be hawkish, but he really managed to even surprise those expectations. His speech was short and to the point and essentially said, we're going to do whatever it takes to get inflation down again. And I think just that admission that they are willing to sacrifice economic activity and jobs, i.e. risk putting the economy into a recession, has really given the market a fright.
Yeah, he said reducing inflation is likely to require a sustained period of below-trend growth and bring some pain to households and businesses. So also kind of an admission here that unemployment rate in America is going to be going on the way up as well.
Well, he needs to get bang for his buck through what he says, because in the US, the most important interest rate, unlike here in Australia, is not the Fed funds rate. It is the 10-year Treasury rate, which mortgages and a whole lot of business lending is priced off. So he has to send a strong message. He said, we're going to go 75, and he's not entertaining any talk of rate cuts, which of course will help put some upward pressure on those longer term rates. So it's a very hawkish approach aimed at getting long rates up, as well as obviously the actions of him raising the short rate. And, you know, he's really gone all in on tightening policy now.
Where does this leave the Reserve Bank of Australia? They've got to make their cash rate decision next week. What are you expecting from them?
Well, they're in a similar position. They're just 3 to 6 months behind the Fed. And as we're seeing, the economy is strong. The labour market is strong. That is the overriding objective of all central banks, is to get labour demand back down into balance with supply, i.e. to take that wage pressure out of the economy. So I think a more hawkish, a more aggressive Fed in the next few months is going to result in a more aggressive RBA. And I think they're basically not going to stop and even think about it until they get that cash rate close to 3%. So I think we can expect a 50 next week and potentially another 50 in October.
Retail sales numbers came out today as well, and sales up 1.3% in July to almost 35 billion. Is this a bit of a worry? Aussies are still spending all that money despite inflation continuing to creep up.
Yeah, well, we don't know how much of that strength is due to inflation, but the magnitude of it over a percentage point in the month says there is underlying demand there. There is underlying strength in consumer spending. And of course, you know, for all the indications of interest-sensitive sectors such as housing responding, and even goods spending in that report today was a little bit softer, the reality of this economy and the US economy is strong jobs growth, and now wage growth means that people have got money and they're going to spend it.
Warren Hogan, independent economist, thanks for coming on the program today.
Thanks.